We like to make the distinction between alternative strategies and alternative assets. So by alternative assets, we mean commodities, infrastructure, tend to be long-only investments, what we call in jargon speak beta investments, whereas alternative strategies are generally just different ways of managing traditional asset classes like equities and fixed interest. One big aspect of alternative strategies is that you tend to get much less of the market return and more of what we call alpha or skill-based returns, whereas traditional assets, you're really just getting the market. Now we think that's really valuable right at the moment because our outlook for passive traditional market returns is very low at the moment, so we believe alpha is a valuable addition to a portfolio. The current environment has been extremely choppy, in no small part due to the influence of central banks adding a lot of liquidity, threatening to withdraw it. It's made it quite difficult for global macro managers in particular, who like to trade on themes, go long particular currencies or particular countries. They did very well early on in the year, funnily enough, sort of on the back of sort of betting on a stronger US dollar, the US recovery. However, a lot of that's been sort of caught short by the tapering talk in the US in the last few months. One thing that global macro managers, certainly good global macro managers do in this environment is they pull their heads in, so they reduce risk in the portfolio. So even though the trades and themes are difficult at the moment, they're not losing a lot of money at all. In particular, amongst global macro managers, there's a subset known as managed futures managers, who tend to systematically bet on trends. Now in this environment where trends have been reversed quite quickly through not just central bank intervention but sort of political intervention, they found it difficult as well. On the flip side of the ledger, equity strategies, which struggled a couple of years ago when the environment, if you remember, was very risk on, risk off, have found they're going a lot better in the last 12 months. We've seen a lot of reversion to fundamentals, a lot of a sort of lack of correlation between sectors and equities and stocks, which make it a fertile ground for these managers who are going long particular sectors or particular stocks and selling short other particular sectors and stocks. Also, there's another big class of alternative strategies managers called event-driven managers. As the name might imply, these managers trade around particular events, certainly corporate events like mergers and acquisitions. Now, the environment's actually quite good for those managers because in this world where returns are low, where companies have been able to sit on cash, that's been a good place to be in the last few years, then now company management's getting a lot of pressure to do something with their money, do something with their balance sheets, do something with their cash. And this is a good environment for those managers. We've recognised that alternative strategies is a complicated asset class. So to pick the managers and strategies for this part of our portfolio, we've partnered with a specialist alternatives manager in New York called Ramus Alternative Solutions. Now they're what would have been known as a hedge fund of funds a few years ago, but are now very much an alternative solutions advisor. This allows us to leverage off their specialist and in-depth manager research, not just on the investment side, but also on the operational due diligence side, which is very important with alternative strategies. We believed it was very important within this asset class to not just target one particular set of alternative strategies, but provide a diversified range of managers and strategies in the portfolio. So through the partnership with Ramus, we've been able to structure a portfolio that contains 16 different managers in different strategies doing different things, which gives us the smooth, consistent set of returns that we're after. I think the first thing we do in managing risk is make sure that we've created a portfolio in the first place that is very well diversified across different managers, across different strategies, and across different risk factors. And by risk factors, I mean things like the obvious one is the equity market itself. We don't want a portfolio that becomes very correlated with equity markets. We believe that investors investing in an alternative strategies portfolio are looking for something that is different to the market and market risk. But we also are looking for a portfolio that doesn't have a too big exposure to things like currencies or even particular stocks. We wouldn't, for example, want to have a big part of the portfolio dependent on the success of a stock like BHP or Rio. To do this, like I said, first of all, we invest in a diversified range of managers doing different things. But then a very important part of what we do is also the monitoring aspect, where on a daily, monthly, quarterly, annual basis, we're looking at the portfolio and making sure that we aren't exposed to risks in one particular area. So what that means for advisors and their clients is that the fund can be expected to provide a sure and steady daily return. In fact, it's actually quite rare for the fund to lose or gain more than 0.1% in a given day. But hopefully over a month or a year, what we're doing is providing a constant return over cash. So the fund itself targets a return of cash plus 4 to 5% after all fees are taken off, with a very low volatility of returns. And we believe in this sort of period where outlook for market returns is low, that's extremely valuable in a diversified portfolio.